In this video, we're going to discuss a better way to execute the popular wheel strategy. We're going to use Amazon for our example purposes in this video. So let's jump into this.
Start channel. Happy trading.
Let's look at Amazon with 31 days to go. At the Dorian Way, we try to teach our members how to use the wheel strategy, or what we call the safeguard strategy, based on selling options 7 days out, 14 days out, 21 days out, or 30 to 35 days out. In this example, we're going to show you 31 days out for this Amazon trade. So a typical will strategy is trying to replace the process of just buying shares outright at the going price. Right now, Amazon is trading for just over 104. If you were going to buy 100 shares of Amazon right now, it would cost you about $10,400 to buy 100 shares of Amazon, and you would have risks all the way to zero. Not that we think Amazon is going to zero, but that's technically what your risk would be if it went out of business. The wheel strategy tells you to sell a put to start off with, and you can sell a put in the money, you can sell a put at the money, or you can sell a put out of the money. In this example, let's just say we're going to sell a put at the 100 strike. So if you sold a put at the 100 strike, instead of having $10,400 of risk, you would only have 9,680, or just under $9,700 of risk, because you are selling that put with a strike price of 100, and that's giving you a discount because someone's paying you a little over $300 and your cost basis is around $97 because someone's paying you a little over $300, as you can see here. So the wheel strategy is better. We believe it's better to sell the naked put first than just outright buy the shares, because if you sell the naked put with the premise of you're okay with taking ownership of the shares, then you're always going to get it for a discount. And so once you sell that naked put with the will strategy, then if you have to take ownership of the shares, then you come back in and you do what is called a covered call. And that covered call is usually something that's sold at the money, but most of the time something that is further out of the money. Okay, so something like this. If you had the shares right now, you would sell a covered call. Selling a covered call is like renting out your house. Your shares are an asset. Your shares are like a house that you can rent out if you have at least 100 shares. 100 shares is considered a standard lot in the options world, or just in the the stock market world, period. And so this is the normal type of wheel strategy. It's just two strategies, two processes. You sell a naked put, and then if you have to take ownership, you sell what is called a covered call. That is a conservative strategy, but we believe we have a better will strategy. We call it the safeguard strategy. We add two more strategies to the process. So for example purposes, instead of just selling this call at the 110 strike, you can take some of those monies and buy a put to do what is called a collar strategy, to lower your risk to the downside. So in this example, you have risk technically still all the way to zero, right? Less than the person who bought the shares outright at the going market price, but you still have risk all the way to zero. If you take that capital and you actually buy a put, so let's say this you're receiving just under $300. So let's just say you decide that you were going to buy a put around this 94 strike. If you bought a put there, you can see that your max loss has changed from over $10,000 in this example to just under 900, right? Because you're doing what is called a collar strategy. A collar strategy limits your upside and also limits your downside. Okay, so it's bracketing off your risk. You have It's bracketing off your reward and your risk. So this is how it works out. You stop winning if it goes above the 110, and you stop losing if it goes below the 94 strike here. So this is called a collar strategy. It's bullish, just like a covered call strategy, just like a naked put, but it gives you more protection than the naked put and the covered call, right? This collar strategy gives you a significant amount of protection, and you can decide how you're going to adjust this trade to give you less protection or more protection. So for example purposes, if you had the shares and you wanted to sell something at the money like this, then you can have risk literally you can stop your risk to the downside completely for the most part here. As you can see, you only have $5 to $0 that you can lose here because you're buying the put at the 104 and selling the call at the 105. That selling of the call at the 105 is more than the put that you are purchasing. So you basically have very little to no risk to the downside on this trade. Yeah, you can't make a lot, but you can still make something. That's $95. That's good, right? You can still make up to $95 if it goes above 105 and it expires above 105. Okay? So this is called the collar strategy. You can play with it at the Dorian Way. We teach members how to use this in a safe way. We call it a better buy and hold type of strategy because you're always low in your account spaces and you're setting yourselves up to deal with bigger down moves in the market and so forth. All right, so another way that we make the wheel strategy better is that we start with a covered call sometime. You can start with a covered call, but usually if we're going to start with a covered call, we're starting with something deep in the money, right? So for example purposes, if I sold this call here at this 80 delta, okay, at this 80 delta, I'm going to have an 84% chance of not only winning, but winning this 170 that I'm receiving. Okay? Because I'm selling a call in the money, it's basically going to be a guaranteed or close to a guaranteed 84% chance your shares are going to be sold away, or better known as called away. We like at the Dorian Way, we like to use the the terminology of sold away because you're selling something. It's okay to sell something if that's the price you want to sell it, right? If you have a car and it's worth 20,000 and you want to sell it for 21,000, that's fine. You can sell what you own at the price that you deem is appropriate. And so you own these shares, you can sell it in a deep in the money call to be taken away, but someone's going to still pay you some money for that, right? So this is giving you a high probability that over the next 31 days you're going to make 180, not just win but make 180. Or you can do what we call your no downside risk deep in the money covered call, right? You can take some of these monies, which you're receiving about 170 to 180, and you can buy a put at the same strike price as your call. So in this example, if you buy this put here, you're going to be able to make some money and make it in a no risk way. Okay? You can buy the put and you can see that you have no risk to the downside, and you have basically 100% chance you're going to win this $50 if you can get filled at this price. We call this the guarantee deep in the money cover call strategy. Okay? We teach this at the Dorian Way. We also teach one more strategy, what we call the Bionic Bull, that it gives you unlimited upside potential. So most naked puts that you sell do not give you unlimited upside, or no naked put that you sell gives you unlimited upside. But if you sell a put and buy a call, you can have unlimited upside. We teach that at the Dorian Way. So for example purposes, if we wanted to sell this put here on the 31 days and buy this call here, well, we'll have unlimited upside. As you can see here, we have unlimited upside because we have just purchased this call for free, and you can see that this is a put that we sold. Okay, so we're still collecting $125 in credit. So someone's paying us to buy this call, and we have unlimited potential to the upside, and we're okay with taking ownership of these shares of Amazon if it goes below 140. Our cost basis is still be lower than what it's currently trading at. Okay, so this is what we teach at the Dorian Way. We add two more strategies to the wheel strategy, and we believe it's a better wheel strategy. We call it the safeguard strategy. We teach people to do this in their IRA accounts, or you can do it in a margin account, but these are safe strategies that allow you to build wealth over time. You can do this on a weekly basis, every 2 weeks, 3 weeks, or every 30 days. This is what we teach at the Dorian Way. If you're interested in learning more, please write a comment below, like the video, subscribe to our channel, and consider joining the Dorian Way. Thank you for watching this video.